Greetings, Wycoffians. Welcome to Power Charting. I'm Bruce Fraser, your host. We are going to continue our discussion from last week where we talked about a 2023 outlook, the Wyckoff view, part 2. So with that, let's get started. This chart is the S&P 500 going back to the top that was made at the end of 2021. You've seen this chart many times. It's got lots of annotation on it. This is a working chart, a study chart. I encourage you to screen capture it, study it, put your own notes on it. This is my Wyckoffian interpretation of the downward structure of this trend channel. And we are at a most interesting place right now because you can see that at the end of, well, here in right there in December, we rallied up to the overarching supply trend line. That supply trend line is where supply tends to come in. Wyckoff is very specific about how to draw these. We've drawn it on these two points that are approximately of equal size and duration. Oversold line is drawn on the intervening low. Beautiful chart structure of this downtrending channel, very useful to us throughout all of 2022. Now, in December, we rallied up and touched that overarching supply trend line right here and reacted off of that, but something very important happened there. We reacted off of that back to support as established by this preliminary support low that was set in May. And that was a very important decline with a lot of supply in it. It was really maybe the worst decline of the year, that whole structure, followed by a decline August to October, end of September, October. And that was also a very big, important decline. Well, look what happened. We had a December decline, which I think was tax loss selling that was taking place into the end of the year. And that tax loss selling was followed by another rally up to the overarching supply trend line. Now, this is a very important place for a number of reasons, and I really want to clarify my view on this because there was some great comments I got. I love your comments. Keep them coming. Where I sound a little too bullish. Well, you know, Wycoffians, we look at the market. We establish what we believe to be the present position of the market, and from that, the likely future direction of the stock market or any market that we're studying from there. And so this is really what I'm attempting to do here. We try to be in the moment, let the market tell us where it wants to go, rather than imposing our view on the market. You can see above this level that there's supply, lots of supply. This trend, this red trend line across here is supply. We have a very important 200-day moving average, and the moving average was touched, was slightly exceeded here, touched here, and now here we are back at this level again. This should induce more supply because so many people look at the 200-day moving average. Quite important. And looking at that, we can see that we've gone back up. We're knocking on the door, not only the 200-day, but also the downtrending supply trend line. And we have overhead resistance that we can see here in a couple of different places. I'll get more into that in a minute. I want to show you a point and figure chart. And this point and figure chart is a swing trading chart, one box reversal method, a chart that I did back December 1st. And that chart, you can see, has a swing trading count, and across this yellow shaded area, 4,100 to 4,350. Makes a lot of sense because here's 4,300 right here. 4,350 is one box above that. Also, these areas of stopping were also at that level. And we've gone up and touched 4,100. And that 4,100 level, as we can see, did stop the advance of the market. And this is concerning because we have lower highs throughout, lower high, or high, lower high, lower high, and that implies the continuation of the downtrend. And so we always allow for the trend in force to continue. And we can see that over here on the right, that all we've done is we've rallied up to the downtrend line. We've rejected price off of that. We're attempting again, could very well reject price off of that again. This is just a failing rally in an ongoing downtrend. And we have to keep that in mind and consider that. We're always being tactical in our view of the markets. We know this is a very high risk market in the regard that we have a hostile Fed raising interest rates. We have downtrends where a lot of people have taken some pretty big hits in their growth stocks in 2022. Other areas have done better. So let's keep that in mind. But what we did notice at this time was that we went up into this objective range and that we could have some kind of a pullback from there and build even a bigger count. We even said at the time that this accumulation structure was likely to get bigger. Well, here we are. This is the pullback from 4,100, an attempt to rally here. We've only gone back to 4,000. The count has grown bigger. The reason why is because we came out of the swing trading accumulation area and then pulled back to the top of it. Old resistance becomes new support. Attempting to rally now, we can take this count. It's a preliminary count because we haven't taken out the 4,100 high or gone up to the 4,300 high. And so we would watch for that to happen to confirm that this count is in fact valid. Gives us a count to 4,500 to 4,800, and that actually takes us back right to the 2021 high in the S&P 500. And that takes us to, well, let's look at this analog as a possibility for what could happen if this is an accumulation structure that we're looking at. This is the Dow Jones. The top chart is 2002, 2003, with very important accumulation structure that led to a bull market in the later years of that decade. This is not only a highly correlated view between these two markets, 2021, 22 into 23, but also this 2002-3 area. Also, we have the dot-com era, growth stock era compared to the mega cap growth names that we saw massively going up in this cycle. And so far there's commonality. Notice the lower highs at 4 and 6, and then an important decline in the March of the third year. Think decennial pattern here. We talked about that last week. Long grinding decline into a higher low completed the accumulation structure. Bull market started thereafter. Here we are seeing a pullback as we did from 0.4, a rally into 6. We may be having that now to a lower high, and then a grinding decline for more than 2 months, or call it 2 months, and with a higher low. This is just nerve-wracking for traders because there's no lift in this market. It just goes down and down and down and down. But the thing we see in it is that it takes a long time to get from 6 to 7, and there's less force in the move, less supply compared to, say, from 0.2 to 0.3. And also the earlier period that we saw before that, this is this shows absorption. This is a reduction in volatility, but very much could be our future as we go forward. Now I'm going to go through and get all of this chart up to date. We talked about this last week. But let me just say one thing about that. I had made the case that, especially with the decennial pattern, that we could have a run up here into, this is 1968. This was a presidential election year. And this is the the pre-election year. We looked at seasonality for that last week. Check it out. The little base was formed. Two-stage rally occurred. I'm looking at this whole area here as being potentially a bigger distribution. A lower high here, testing this high in 65, 66. And this was a very nasty bear market that followed. So I don't want to characterize myself as bullish or bearish. I'm looking at this and saying, well, what is the potential? We may have already had wave one up, especially when we look at the Dow Industrials. But we have a mid-year, let's say we have a mid-year consolidation. Seasonality implies that. Early year strength, mid-year consolidation. 2024, we have another good rally, and then we have some kind of a double top, and this rally could go to a new high. I'm putting that out as a possibility, as an analog, mainly because this 60s, 70s period has a very similar trajectory of CPI, of inflation, and that the inflation, and we just had PPI come out today, and recorded this on Wednesday. I think my cover page said Tuesday, but recorded this Wednesday, and PPI is out, and it's actually declining in the last reading. So, but there's a lot of other components that go into CPI, but there's very definitely a slowing, which could moderate the Fed's policy decisions going forward. Maybe not initially in the first meeting or two, but they're going to be, I think, get into mid-year, and especially if these numbers continue to moderate, and they're going to slow the rate of ascent of interest rates. More on interest rates in a few minutes. So big bear market after this period, I think that's possible. This is possible too, but we need to keep in mind that we could just break down and go to new lows and just keep declining. And that's why we have to be very respectful of the hostility of this environment and the resistance that's directly overhead in the markets at this time, and that the market must prove itself and get through and create a sign of strength, show the ability to get through prior highs, through resistance at the 200, at the downtrend line, at the prior high. And so here is a chart that shows this low across here in the S&P, and it rallies up to 40.25 to 41.75. You know, we went up to 4100. And I said at the time that we were likely to build a larger count if this is accumulation, and that we would have some kind of a pullback like we just looked at in the 2002-3 analog, maybe into March of this year. And so far, in fact, that is exactly what has happened. I put in 3 new counts. I just threw in this redistribution count so you could see this count came to be, and look at how it stopped the decline. Now we have 3 counts at work here. This green count is the working count that we would focus on here, which encompasses that whole area that we just talked about. This is a 3-box reversal chart, 25-point scale. 43.25 up to this high, 45.75. We need the market to prove that it can get through these resistance areas we just discussed and get up to this level, and potentially this level, which we would call a major sign of strength. Thereafter, have a more important pullback. Does that happen now, or does it happen, say, in March after another decline? If this is accumulation, who can know? But all we can do is follow the tape and let the market tell us where it wants to go. Okay, and then here is the NDX. I'll just go right to this chart. The NDX is so interesting at this point. This is a chart I showed you a week ago when we talked about the outlook for 2023. Overarching supply line, rejected off of this level in early December, had a more important decline than the S&P, and almost got to the prior lows in October, and then held there. Now what is happening? Because we've said that these growth stocks, especially the Nasdaq 100 growth stocks, such large cap dominant names, need to rally because they're in the S&P, they're in the Nasdaq 100, they're in the Nasdaq Comp. They're the big dogs, and they need to eat, and they need to run up. And when they run up, they need to take out overhead supply, and that's going to lift all of these major indexes. So let's talk about the lows that we got in 2022. This is really important, I think. So here's the March low, the June low, the October low, and here's the year-end December low. And notice how each one of these lows is lower, goes down to the oversold trend channel line, stops there, builds a cause for a swing trading rally, and then rallies up to the overarching supply trend line. Well, this time, notice what happened in December. December, you had a sell-off. Now, that would have been the month when you would have had the most important supply showing up, because December is year-end tax selling. Institutions want to get these stocks off their sheets or reduce their exposure because they're going to have client meetings in the new year. They're going to be evaluated by their clients. Individuals and large taxable accounts are going to be selling stock to be able to book losses, or generally book losses into the end of the year. Well, so we have a change of character. Instead of lower lows, we got a higher low. Well, what has happened since? Now, this was just on January 10th. So let's look at what happened after that. Here are some notes from last time. I'll let you read those as you have a minute. But here, this is what has happened. This is through the 18th today when I'm recording this. We've rallied right up to and through the downtrending supply trend line here, and we are stalled. As a matter of fact, there's a tremendous amount of selling today. The Dow's down almost 500 points right before I recorded this. And so no telling whether this is going to induce another selling wave down towards the lows, towards the bottom of the trend channel. We will just have to watch and see. But what we want to see is stability here in the ability to not only get through on the Nasdaq, this supply line, but also get through the overarching 200-day moving average and get up to the resistance levels. Very, very important. And then just drawing this green circle around this very important juncture that we're at right now, and how the market was able to go up to and through the downtrending channel line, supply line, and then reject that and go back down again. So we can see, even though this was a much more muted decline here, that it's great. It's less than this very big decline from August, very big decline from April, May. And let's see whether or not it can now show additional character by going up to these higher resistance zones. Such a critical moment at this time, and I really want to make that point to you. Yellow shaded area just illustrates where the overhead resistance is in this structure. And you can see that the NDX is much weaker than the S&P 500, and that is because of the dominance of those mega cap names. Here is a chart. This is from December 2nd, and this chart shows the distributional top back here, 2021-22, right over here. And then you can see redistribution here. These are reconfirming counts down to these lows, and stop the decline. This is the area that we just evaluated. Nasdaq Comp looks a lot like the NDX. More stocks in it. It's a very interesting index because there are so many good companies that are smaller that are not relevant, very relevant to the calculation of the index, but are very important potential trading stocks. Here is a chart through yesterday, January 17th. Here is the count, and you can see this count across here. It's 21 columns, and this is a swing trading count, but it's a 3-box reversal, and it's substantially large. And so this count goes all the way up to 16,400, which is right back to the old highs. We can't tell how long it would take to get up there, But now we have structure, cause built that could propel the market higher if we can get through the overarching resistance that we've just talked about. Now, let's just take a minute and look at the Russell. The Russell is so interesting, and got to keep track of time here. I'm running out. But let's just go through, and I'll note this, but I want to make the point. Relative strength of the S&P. The Russell has been leading the S&P in performance literally since May, and the Russell has been outperforming since February the Nasdaq 100. And so the Russell really is an important leadership index at this time. Doesn't have the big exposure to those mega cap names. And so here, to put a Wyckoff-ian kind of an orientation on it, let's call this preliminary support. This is a selling climax. This is an upthrusting action, which also has the elements of automatic rally, but I think this might be the automatic rally here. And then you have a secondary test, and then up you come to resistance, turn back down. This might be LPS. Look at the quality of this rally, persistent right up to resistance. Now it needs to get up and out of here, have some kind of a backup, and then be able to continue. So ability to be able to have a pause without a lot of downside volatility would be very good to see here. All right, let's change gears here. This is just the dollar. I'll go real quick. And you can see here that the dollar had a big breakdown over here on the right. And here's a point and figure chart, December 1st. And you can see here distributional top, had a count that went down to 2840, 2760. And we took that count at the beginning of December. We actually, I think we did a super job on the dollar, because when it went up and touched this buying climax peak, which was a trend line, trend channel that had been forming for years. This goes back to 2014. We've been using this chart for many years now and showing it right here. And so then it went up. Here's on a daily chart, climbs up to, throws over the top of the short-term trend channel. Here it comes up and touches the long-term trend channel, and then reverses very sharply as it's done here and here. Here's the point and figure count of that. And we would not necessarily call this the final low, but this would be an area where we would expect a pause in the decline. And here's what's happened since. And this is actually up through yesterday. And you can see we went down and touched 2760 yesterday. And in fact, today we went one box through at 2750. And so we should stabilize here for a while. And we'll watch the dollar closely. But the dollar's been quite weak. Point figure's done a super good job of guiding the way for us. Beautiful trend channel on the point figure chart also. Now, turning to interest rates, a couple more minutes left, is here's a, well, two ways to look at interest rates. You've seen this chart before, many of you, and this is the price of 20-plus year U.S. Treasury bonds in the TLT ETF. So this is all treasuries in this ETF, big distributional top, really a wicked big top with a high of 152. Look at this count. You take this whole count, it goes down to 101.91. I mean, it's almost unheard of to think that you could have more than a 1/3 decline in bond prices. Redistribution count in yellow counts down to 93. And I've just pasted what has happened since. So this is up to date here, even though this says September 28th, end of the quarter. Look at what's happened. We went down, touched 92, one above this low, one below that low, confirming counts, and had a very sharp advance up to 108. And now it looks as though we are stabilizing, building some kind of a cause, probably going to be range bound in this area for 20-plus year bonds for a while. But that's a huge bounce here. Could be a sign that there's something bigger brewing and there's going to be work done down here to build a cause. This chart on the left is the U.S. Treasury 2-year yield. Now we're not counting price, we're looking at yield. So falling yield equals higher prices. They're inverse. So we see here a chart of the 2-year Treasury yield that goes down, and this is through yesterday, to 395 to 370 from a high of 470. That's a full 100 basis point decline in the very short-term 2-year yield. And we are falling. And we had beautiful point and figure counts that went up to this area, as was this, just an epic point and figure count over here. Now, let's look at the 2-year. Let's look at the smaller time frame. This is same construction. We're just looking at a smaller count. This count goes 415 down to 390, and we are just about to go into this 415 area. And I think that we could go down and just spend time here between 415 and 390 in the 2-year for a while. So there's sort of my outlook for treasuries for the time being. This is how much information we get from point and figure. Now, lastly, this is my absurd moment in Wall Street. Wall Street is a crazy, crazy place. This is Exxon, and Exxon is we looked at a point and figure chart of Exxon in 21 back to 20. That's the green shaded area. You can see this up close on the right in that point and figure chart. Counted up to 116, 128. We were at $45 at that time. What has happened since? And that is that we've gone up to that level. We are now there. And so Exxon is up to that level. But here's the crazy, absurd part. Pointed out to me by Joe Turner that CRM replaced Exxon in the Dow Jones in the end of August of 2020. Note how the place that happened. This is the low in Exxon. This is a test of the early 2020 low. Here is a high in CRM, Salesforce. And look at how they are polar opposites of each other. They're almost like mirror images. Here's the relative strength of Exxon to CRM. And this is the point at which CRM replaced Exxon in the Dow. And this is the relative strength of Exxon on the way up. If you had made a decision to buy or sell based on when stocks were put into these major indexes, you might find that there's a very contrary orientation to this. Why would they take Exxon out of the Dow? It absolutely puzzles me, because imagine what the value of the Dow would be if Exxon had stayed in the index. It certainly would have helped. And instead, we had a decline in CRM. And with that, I will say goodbye for now. Thank you so much for being here, and we'll see you next week on Power Charting.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.